Today we're going to do a deep dive into EMX royalty to figure out if it's a buy or not, and this stock trades under the ticker EMX. And keep in mind, these are just my opinions based on my own research, and you should always do lots of your own research before and after buying shares in a company. Let's first talk about the pros and cons of the company. First is they have a safe business model. So what EMX does is they use their team's geological talent, and they have a lot of geological talent on the team, smart geologists, and then they use that knowledge to acquire prospective mineral rights around the globe. And they're most focused in Scandinavia, Eastern Europe, and the Western US. And after acquiring these mineral rights, they do some minimal work that isn't expensive, and then they sell the projects onto other companies who advance them at their expense. And when they sell those projects to these various companies, they'll typically receive a small payment each year or a bigger payment at certain milestones. For example, they might get a payment when there's a pre-feasibility study done on the project, and then maybe another substantial payment when they declare that they're going to start construction. And then after the mine is built and it's producing, well then EMX always holds back a royalty. So that's how they can generate these mineral royalties at a very low cost. The big drawback about this plan is that it takes many years, often decades, from the time you start generating a project to the time that that royalty is actually producing, if it ever does produce. But thankfully, we have something like a 25-year history of them doing this in the past. So some of these royalties that they've generated long ago are advancing towards production, and some are even in production. So they're finally starting to get revenue from work they did 20 years ago. Now that might have been very boring investing in this company 20 years ago. However, now that all these other companies are paying to advance a bunch of projects and EMX isn't on the hook for any of those expenses, well then this investment starts to look interesting. But the company does a little bit more than that, because they not only generate royalties, occasionally they'll find an attractive royalty to buy. So sometimes they do acquisitions as well. But this business model is great because exploration is very high risk. So when you can have other companies funding all the exploration expenses, and then you have like 200 different royalties around the globe, some of those are probably going to work out. Most of them probably won't, but some will. And all of those that didn't work out, you didn't spend much money on. So that's one reason why this is low risk, but also it's very powerful to own royalties. And it's a low risk exposure to these various minerals. And the minerals they're most exposed to are copper and gold. But something I like is that EMX has this low risk exposure to huge projects. And for example, when a company is operating a copper mine, if they have a long life asset, they're probably going to put a bunch of money into that to expand that production facility. Maybe a copper miner invests $2 billion to double production over the next few years. And when this expansion takes place and production grows, well then EMX's royalty revenue is moved forward, improving their net asset value at zero cost to them. But also over the years, the price of the metals tend to go up, while the cost of mining go right up along with that. However, when you own a royalty, your cost never goes up because you don't have any costs associated with that in the future. You get all of the advantage of the metal price going up in the future. But if copper goes up to $8 a pound, the producer's cost might double as well, and they're not actually making any more money at $8 a pound than they were at $4 a pound. Now they might, but it's not always the case. And something else I like about the company is that they're reasonably diversified. They have 6 producing assets, so those are royalties that are cash flowing to them. But remember, they're also getting those staged payments from a bunch of other assets every year, or when there's major milestones, things like that. So they're also getting revenue from other projects. And then they have 7 development stage projects. So these are projects that have already had economic studies done on them. And then in addition to that, they have over 100 exploration stage royalties. Now, most of these 100 probably won't work out. It probably won't end up being a mine, but maybe 5 or 10 of them will in the future. So this is all growth that's already built into EMX that I believe EMX isn't getting any value for today. Another thing that attracts me to the company is that their enterprise value relative to their NAV is very low. So it looks like it's a good time to buy. However, we're going to dig a lot more into this later in this video. And something else I like is that the company has a strong balance sheet. And also, I mentioned that they have some royalties up here, but one of their royalties is on a world-class asset. And it also attracts me that they have increasing revenues almost every year, while at the same time, their general and administrative expenses are staying pretty stable. And now let's talk about the cons. One of the first things I noticed in my research was that management salaries seem kind of high, at least high relative to revenues and relative to cash flows and things like that. Like for example, the CEO and executive chairman are making like $700,000 to $800,000 per year. And I struggled with that because I really like the company and I really love the valuation. But I was wondering, are they paying themselves too much? And is the stock cheap because their expenses are too high and because us shareholders are going to struggle to make money? After struggling with this for a while, I asked myself, would I rather the company save money by paying somebody else, hiring somebody else who's maybe less experienced, who's maybe not as good of a salesperson, who's maybe not as experienced in geology as Dave Cole, the CEO, for example? And my answer to that was a resounding no. So when I can say, yes, I would definitely rather pay Dave Cole $700,000 or $800,000 a year and have him running the company versus paying a less experienced person less money and having that person run the company. So although I struggled with this at first, I don't anymore. And something else I struggled with this company is that G&A, general and administrative expenses, seemed high to me. Like back in 2020, revenue was $7 or $8 million. G&A was $7 or $8 million. But since then, revenue has quadrupled while G&A has more or less stayed flat. So this chart starts in 2016 and goes until 2023. The dark line here is their general and administrative expenses. So it increases a lot right about here and then stays more or less flat until 2023. Whereas the other line is the revenues. It starts at 2.2 million and then goes all the way up to 26.6 million. But this actually isn't taking into account the revenue from their Caserones mine. So we would actually see this revenue line quite a bit higher here if this included that revenue, which it should, but just because of the way they own that Caserones royalty, they can't include it in their top line revenue. So in 2023, the general and administrative expenses for EMX were a little over $7 million. Now for a company the size of EMX, I was thinking that was too high. But then I looked into that to see what comprised that G&A expense, what comprised that $7 million, because that was the biggest thing keeping me from investing in the company. And 1.1 million of that is accounting and legal expenses, and much of that goes to defending the royalty interests around the world. That's a pretty big portion of that. Of course, you have like management salaries and stuff too, and general corporate office expenses. And then also of that $7 million, about 800,000 was spent on investor relations. Although I would like to see that number lower, I do understand it because that's not just stock promotion. That's not just like how much they're paying to YouTubers to advertise and paying to like Kitco or wherever else they advertise. But that's also them going to conferences, them getting in front of investors, and also all internal investor relations expenses. So like the presentations you see on their website, for example, there's a cost to getting those, and that's part of that cost. Although I don't love that $800,000 investor relation expense, I understand it. And after looking into it, I'm more okay with it now than I used to be. And something else that goes into those general and administrative expenses is their listing expenses on the stock market. They have a New York Stock Exchange listing, and a lot of companies don't. Actually, most juniors do not. To be able to get that 3-letter ticker that allows people on, for example, Robinhood to be able to buy the stock, there's a lot of expenses involved with that, and there's extra compliance costs involved with that. So that's something else that's contributing to that G&A, which makes it more tolerable. I still don't love this G&A, but it's a whole heck of a lot easier to swallow after doing a whole bunch of research into this than it was before. And that, like I said, that was the main thing keeping me from investing in this stock. So after researching this a lot, I'm more okay with that G&A than I was before. And when I started looking into this company, something else I was concerned about were there other expenses. Because if you look at the income statement, you see their top line revenue, and then below that, you see their cost of revenue. And then after you subtract the cost of revenue, you get the gross profit. Well, they're a royalty company. Their income is coming from royalties, or mostly from royalties. So I was thinking they shouldn't have cost of revenues. That should be zero or close to zero. So why was it over $11 million in 2023? And after doing a little bit of digging, the reason for that is those other royalty generation expenses. So the royalty generation that they're doing today that will likely pay off many years into the future is being subtracted. Those expenses are being subtracted directly out of revenue, which is good for income taxes in current years, but it makes the company look a lot less profitable than they actually are. Overall, I'm totally fine with these other expenses because that's going to ensure the company's long-term growth. So as you can see here, I had some cons listed out, but then after doing a bunch of research, I came to decide that what I thought was a negative for the company either isn't a negative at all or is less of a con than I originally thought. But one con that hasn't changed is that I see no catalyst in the next year or two that's going to really propel the stock price. I don't see any one thing that's going to happen in the short term that's really going to move the needle for this company. That's not necessarily a deal breaker though, because remember they have a really low price to NAV that we're going to get into here in just a moment. And I think if you buy a royalty company when it's cheap, who has exposure to long life assets, especially assets that are producing already, well then you're going to do really well over time. Now it makes a big difference buying a royalty company that has royalties on assets that are already producing versus buying a royalty on a company that has assets that aren't producing, because a royalty on an asset that never goes into production is worth zero because you're never going to get any cash flow from it. And especially with these big copper mines, it's getting almost impossible to permit and get these things into production, and they're getting so expensive to build. Like, it is not abnormal for a copper mine to cost over $10 billion to build. But when you have royalty on a long life copper asset that's already producing, I think that's going to pay huge dividends over time. And I'm going to go into more detail about that here in a little bit. Another thing that attracts me to the company is that the stock price is down about 50% from its early 2021 peak. And since then, top line revenue has gone up 336%, and the gross profit over this time period went from negative $1.2 million to $20.7 million. And you know what? A lot of companies advertise things like this. They're like, look how much our revenue has grown. Look how much our income has grown, or how much our cash flow has grown. But you know what? Maybe their revenue grew 300%, but their share count grew 300% over that same time period. Or alternatively, their revenue grew 300%, and then their share count doubled, and also they took on a ton of debt, so now they're way more leveraged. And they were able to grow because they took on a bunch of debt or because they blew out their share count. But here, revenue's way up, gross profit is way up, and the debt hasn't really changed much. The debt is very reasonable. They only have a little bit of net debt, which could be paid back with about a third of a year of revenue plus the cash on hand. So they don't have much debt at all. And then during that same time period, their share count has only increased by 33%. So overall, on a per share basis, what they've done in the last few years is pretty darn impressive. Now I want to talk about the unbelievable value that lies in the company's Timok royalty. So this is in Eastern Europe. It's a huge copper and gold project. And in this you have an upper zone and a lower zone. And on the whole thing, the company EMX has a 0.3625% net smelter return royalty, which is basically off the top line revenue minus transportation and processing charges for that metal. So what's going on here is you have this upper zone that's already in production, and at current commodity prices, this is bringing EMX between about $4 to $4.5 million per year, maybe a little bit more with the currently higher copper prices. Maybe we're looking closer to $5 million a year, and that has a mine life of approximately 10 years. So let's just say the company is going to bring in somewhere between about $40 million and $50 million of revenue from this upper zone royalty in the next 10 years. Now that's good and all, but it's nothing compared to what's going on in the lower zone. And keep in mind, they also have several other cash flowing royalties. So the company is bringing in this revenue from Timok and similar revenue from a few other mines as well. But what I really want to show you is what's going on in the lower zone and how valuable this is going to be for the company. This Timok mine, it's operated by Zijin Mining, and Zijin recently announced that they're investing $3.8 billion to build out the lower zone. And they said they expect the lower zone to start producing in 2026 and ramp up to full production by 2030, which is a lot sooner than I originally thought this was going to happen. Something about Zijin is they tend to beat their estimates. They tend to beat their estimates in terms of the amount of time it's going to take to get to be producing, and they also tend to beat their estimates in how much they're going to produce. They're a very, very efficient producer. Based on their estimates, it already looks good, but it's likely to exceed their estimates. And after they get it up to full production, well, I think they're likely to expand their mill and produce at an even faster rate. The lower zone here is an absolute monster. They have already found 40.9 billion pounds of copper, and this is in terms of resources and reserves combined. And also, they have 13.58 million ounces of gold. And I'm quite confident that they're going to find a lot more of both of these. So although this royalty of just 0.3625% might look small, this actually turns out to be a pretty darn big number. And let's look at what that is now. After doing some research to figure out what their recoveries are likely going to be, we can do some math here to find out what sort of value this royalty, this small royalty, might have to EMX. So we take 40.9 billion pounds of copper times 87% recoveries times the royalty of 0.3625% times today's copper price of $4.46 per pound, and we get a total revenue to EMX before smelter and transportation charges of $575 million. And that's just for the copper we know about. The deposit is still open at depth, and they're going to find a lot more. And it even gets better than this, and I'm going to show you why in just a minute here. But anyway, then we have 13.58 million ounces of gold at 69% recoveries, the same royalty rate. At today's gold price of $26.08 per ounce, you have $88.6 million in revenue from gold over the life of the mine. In total, that's about $664 million in revenue before taking into account the transportation and treatment charges, which probably isn't going to be more than a few percentage points. So you should still be well north of $600 million. So let's say the transportation and processing charges are $34 million from this, and EMX gets $630 million in revenue total. We don't know over how many years this is, but let's just say it's a long time. Let's say it's going to be 50 years. So if we do an NPV5 calculation, assuming $630 million in revenue in equal amounts each year for the next 50 years, we're looking at a net present value of this of about $230 million. So that accounts for the market cap right there. You pay for this, and you get everything else in the company for free. However, I don't believe an NPV5 is a very good way to calculate the value of a royalty over time, because this assumes that copper prices stay exactly where they're at for the next 50 years. And if you look at a long-term price chart of the copper price, it goes like this over time. Of course, there's ups and there's downs, but the long-term trend is like that. Now, also, over time, when an operator has a big mine with huge reserve life, they expand their production and they bring that production forward. So maybe instead of 50 years, it becomes 25 years. And maybe instead of an average of $4.46 copper, you have an average of $10 copper, or an average of $12 or $15 copper over those many years. And when you take those factors into consideration, you almost do not have to discount this. Because when you assume that the copper price will increase a little bit every year, and also they're going to expand production, the new calculation comes out pretty close to what revenue is today, but also this doesn't even take into account that Zijin, the operator, is going to expand the reserves and resources almost certainly. I think we could easily see this being north of $1 billion. This is how an analyst might calculate the value of this. They'll say, okay, it's $230 million because we discounted over 50 years at NPV5 using 5% discount rate, right? And we come out with a current value of $230 million. I think a more accurate representation of the value of this lower zone is more like $630 million. Yes, it's not discounted, but those discounted cash flow methods have been proven to be horribly wrong when it comes to calculating the future value of a royalty, because it doesn't take into account increasing commodity prices, and it doesn't take into account expanding production, and it doesn't take into account increased reserves. But this royalty actually starts to look a whole lot more attractive than this, because here is the upper zone of this, and anything to the left of this vertical line here, EMX has a much larger royalty on. So anything on the right side of this line, they have a 0.3625%, as you see in these calculations. But to the left of this line, they have a 2% royalty on gold and silver, and a 1% royalty on copper and any other minerals. Here, these graphics that you see here were published by Nevsun, the company Nevsun, in 2018. They've had 6 years to explore this since then, so they've almost certainly found stuff on the left side of this line. And one of the reasons why I'm so certain is because the deposit is open that way. They hadn't yet drilled over there. When you look at this one, especially when you see this graphic in color, the highest grades of this deposit are right here, closest to the line. As you go down and to the left here, the grades are higher and higher. So I think as Zijin is mining this deposit, they're going to go deeper and deeper to try to access those highest grades, and eventually they're going to get to the left side of this line where EMX's royalty goes 5.5x for gold and silver and 2.75x for copper compared to what it's normally at. If Zijin keeps mining and keeps expanding their mill and keeps processing more and more ore, and they discover lots of ounces over here, this could go from having a $600 million value for EMX to maybe having a value of $2 billion for them. There's a lot of potential in this as you go deeper, because before we know it, if we're patient with this, I think that deposit is going to be extending into EMX's territory where they have a much larger royalty. Now, we only have this information from 6 years ago because there's limited public information available, because since Zijin got the product, they're not releasing much of that information publicly. So we have limited information to work with. But I have a feeling the deposit has already expanded into this higher royalty zone, that it's going to be significantly more valuable for EMX. And now let's start to get some idea of the company's valuation. They have 127.7 million fully diluted shares. So this is including all outstanding options, warrants, restricted stock units, things like that. And then today it's trading at $1.75 per share. That puts the fully diluted market cap at 223 million. And then you add net debt to get an enterprise value of $230.8 million if you're using the fully diluted share count. And using the undiluted share count, we get an enterprise value of about $208 million. Now, after doing an analysis of what I think EMX's Timok royalty is worth, I think just that one royalty justifies multiples of the current stock price. So I don't feel like I need to do an in-depth analysis of the net present value of all of the other royalties that they have, all the other producing royalties and the development projects, and then put some kind of valuation on all the exploration projects as well, and also put a valuation on future payments, non-royalty payments that EMX is going to receive. That's a lot of extra work, but I already know, just based on my analysis of that one royalty, that this stock is wildly undervalued. So how do we value a company like EMX? Well, they currently have an enterprise value of about 215 million. It might be a little lower or higher depending on how you want to calculate it. From that, you get 6 producing royalties that are bringing in, along with the other revenue, about $30 million per year right now. You have 7 royalties on development stage projects, and then you have 100 plus other royalties on exploration stage projects, some of which will likely be producing in the future. And then you have that Timok lower zone that's going to come into production in just a couple of years that Zijin Mining is spending $3.8 billion on. And I think that is worth at least $500 million. Now, maybe an analyst is only going to give it a valuation of $230 million today. But as the years go on, as next year goes into the next year and goes into 5 years and 10 years, I think each year analysts are going to look at this and investors are going to look at this and are going to say, wow, this is a lot more valuable than I was calculating several years ago. I think this is going to get more and more valuable in the eyes of analysts and the eyes of investors as the years go on. But I put the value at least $500 million today. And then in 2025, in addition to the typical royalty revenue, the company is also set to receive $3 million from Aftermath Silver and $7 million from Abra Silver. So that's going to help out revenues quite a bit in 2025. How do I value a company like this today? Well, I think it's trading at less than half of its value, because I think this is at least what the NAV of Timok lower zone is worth. And then the rest of the company probably justifies the full enterprise value. So I think the stock price could reasonably trade at about triple where it's currently at. So what do I see for a fair stock price for EMX? I think it could easily triple from here, and it would still be reasonably valued. I think it could even run more than that before it would reach fair value. However, like I mentioned earlier, there's no catalyst coming up for this company soon. I don't think there's any one single event that's really going to move the stock price. Now, maybe something happens in the future that I don't foresee right now that really propels the stock price. But from what I'm looking at right now, I don't see that catalyst. Although I think the stock price could go way up. If we're talking a triple, we're looking at $5.25 per share. However, I don't know when it's going to get there. And I don't really expect analysts and investors to value the Timok royalty like I would, because there's a long history of investors and analysts using an NPV5 calculation to determine the present value of a royalty using today's commodity prices, and they don't calculate for those variables that I was talking about earlier. And they have proven to be wildly wrong for decades, which is one big reason why early investors in Franco-Nevada and early investors in Royal Gold have seen such tremendous returns. And even though investing in EMX today, you're by no means an early investor, I do think an investor today is going to see that kind of returns that an early investor in Franco-Nevada had seen, which is close to 20% compounded. Now, you're going to have to be patient because it's going to take time for the market to properly value that Timok royalty. I think as the years go on, the market is going to be assigning more and more value to that. This will be a volatile stock. So maybe you buy it at $1.75 today. It could easily drop to $1.50. If there's a worldwide recession and the copper price plummets, it could easily fall down to $1. So you gotta stomach this volatility if you're going to invest in this, and you gotta be patient. However, with all that said, despite there being no catalyst that I see that's going to really propel the stock price in the near term, I think you're going to see close to 20% returns over the next 10 or 20 years in this stock. So I have to put this as a strong buy. And my risk level for this on a scale of 1 to 10 is pretty low. It's going to be like a 2 or a 3. I think the riskiest thing about buying the stock is going to be fluctuations in the gold price and fluctuations in the copper price. And if the gold or copper price goes way down, yeah, the stock price is going to go down. But if you're buying this with a long-term mindset, with a 10-year mindset, with a 20-year mindset, those short-term moves in the copper or gold price should be irrelevant.